has remained further dollar weakness.
Yeah, and the long-term trends on a lot of these cross assets, of course, ends up adding up to either up or down here for equities. That will be, of course, what we need to talk about and decide on. Kathryn Rooney Vera, head of global macro and chief investment strategist at Bloomberg Capital Markets, joining us right now from Miami. Kathryn, great to have you back. Great to see you in the flesh there on camera. Give us a little sense here of this pullback that we're seeing in the market and whether this is kind of the start of a more longer, protracted downturn or more of a buy the dip opportunity.
Well, I guess we have to ask ourselves, Romaine, what took us to new highs, right? What took us to new highs? Was it really a voracious economic recovery, or was it combined stimuli both from the fiscal and monetary authorities? And if one thinks that it was the latter, then given a retracement, even verging on correction territory, I think one needs to consider if renewed stimulus is in the offing. Doesn't matter if it's fiscal, can be monetary. I think that it's generally consensus that once we get past the November election, we're going to get another fiscal stimulus package. And I don't think that it should astound anyone if and when the Fed comes back into the picture and resumes more aggressive asset purchases. Taylor very correctly pointed to the high yield spreads market is still very, very thin or tight spreads there. And I don't think we should discard the possibility of the Fed increasing its purchases in the high yield market.
Interesting that you talk about, in some way, the sort of bet on stimulus, no matter which way, whether it's monetary or fiscal.
Right.
What then to be buying right here, right now, Kathryn? Because it's interesting that today, in this risk-averse moment, we're selling off cyclicals once again, the most beaten-up area. Should you be buying into that if you're betting on stimulus?
So if we're talking about the equity market, Caroline, I think, yes, I think you should be buying the sectors that have most dragged this upward movement in the broader index. If we're talking fixed income, I think we have to look at the fallen angels. A lot of these fallen angels, which of course are names that upon issuance of their bonds were investment grade, but had subsequently lost that investment grade category by one of the three rating agencies. Those are good candidates for Fed secondary market purchases. So I like fallen angels in the fixed income market. I think we should look at even emerging market bonds, because I do suspect that additional stimulus, as I said, in the offing. And I think that guys need to find yield, and that's going to come back to being the story.
So talk to us more about emerging markets. We started off the conversation highlighting further dollar weakness, which has been the long-term trend. And yet you also smartly point out the big rate differential between EM. Even though they are cutting rates, they're still higher than the U.S., which is at zero. Sure. Where then are the opportunities within EM?
So the best possible scenario for the emerging markets is a global economic recovery, of course, one stimulated by both Chinese and American recovery, Taylor, but also an environment of dollar weakness and the Fed at zero with U.S. in negative real rate territory. So that's a great combination for emerging markets. Once we get back into the risk appetite, scenario, I think that you're going to see flows resume into the emerging market space, starting in fixed income, in dollar debt, in dollar index bonds, and then move into local currency. Because as I said, I think that a low and weakening dollar and very low rates are very positive for the carry trade. The Mexican peso has been spectacularly stable over these turbulent times. And I think you're going to see flows move into the MSCI Emerging Markets Equity Index as well.
And so, Kathryn, with regards to just kind of trying to get a better read on the global economic recovery here, of course, a lot of people, they'll look at copper, they'll look at the industrial metals, but there's been a lot of talk about the moves that we've been seeing in Brent crude and NYMEX crude and the signal that it seems to be sending about that recovery. What do you make of the price action that we've been seeing in the energy space?
Well, it's been pretty devastating, right? So I think that if you are if you're an investor with a high risk appetite, then you should look at a market as oversold as the energy market. But if you look at the risk reward, oil tends to be the most volatile asset class. So I would prefer looking at the sectors that have been most beaten up or have at least dragged, as I said, the S&P 500's ascent, which is industrials, staples, and even banks over energy at this point.
Kathryn, so great to see your face. So great to have you back on the show. We thank you, Kathryn.